And welcome everyone to Founders Q&A with Anthony Millen. This is an open session, things that we've done before in the past with other accelerators where founders can come in and ask a variety of questions have really been powerful. So we wanted to launch something regularly. And Founders Q&A is meant to be, as I said, an informal session for entrepreneurs to ask Anthony Millen, who is a serial entrepreneur, venture capital partner, startup attorney, and of course, the founder of Next, powered by Shulman Rogers. And the idea is to ask, general questions, specific questions about launching and growing a company. This is more informal. Does not constitute legal advice. We would love for you to put your questions into the chat. This is a small group at the moment. We may have more join, but love to go ahead and get started, and feel free to add a question to the chat or unmute yourself and ask Anthony the first question. I'll turn it over to you, Anthony.
Great, thank you. It's wonderful to be here with everybody, and we want to have an interactive and informative session, and so we will just kind of open it up to anybody who has anything to kind of lead us off.
Who wants to be the brave one and ask the first question?
I didn't actually come with any questions prepared. I was interested to hear what other people's questions would be.
That's always valuable.
I'd like to ask maybe a two-part question. Or did someone else, were they already asking?
No, go right ahead.
Okay, a two-part question. I've been through several startups, and now I'm helping entrepreneurs obtain financing for their startup. And a lot of them take the convertible note path. And so one question is, is convertible note the best option? And number two, they take the path of going Series A through Z instead of growing the company where they could be eligible for private equity and take more of a different route and exit either being acquired or going public. So that's the two-part question.
Okay, great.
Yep, go ahead.
No, thank you. That's great. So in terms of the convertible note, there are two early stage securities or structures that people will often use to raise money at a point in time that it is still a little bit more challenging to price the round. So right in this early stage of the company, you have a founder, and we as founders, we see all the upside of our businesses, right? We see the opportunities to grow and how big the market opportunity is and the strength of the team. And then you have the investors on the other side, and they're still looking at all the risks. They're looking at the market risk and the technology risk and the execution risk and the capital risk. And you also at a point in time where you don't necessarily have a track record of a lot of revenue, you may be pre-revenue or in the product market fit phase. And so very hard to put a value. So what people do is they use the convertible note, was the original instrument. And in a minute, we'll also talk briefly about a SAFE and how that came into it, because that's another instrument that's becoming more and more popular. But they use a convertible note, and that convertible note will often, from an investor's perspective, come with a cap, which is the maximum amount the investor will pay upon converting into a priced round. So it is a opportunity where investors can put money in today. You don't put a price on the business today, but you give the investors the ability to come in at a cap or a discount, which gives them some protection and ability to participate in additional upside for taking early risk. So that is, and the convertible note is an instrument that converts when you raise another round of funding, or if you sell the company before you raise another round of funding, or at a maturity date to convert into equity in the company at that discount or at that cap. And the cap usually ends up being higher than what the priced round would be at that moment in time, because the investors have the benefit of not only the upside of the protection that the cap gives them, which is the maximum. So you may have a business where you bring money in and the cap is 4 million. When you do your priced round, the business prices at 10 million. Those investors who came in earlier convert at the 4 million rather than the 10 million valuation. What happens though with convertible notes is that they ended up having the maturity date, which added some additional complexity, because if you raise $1 million or 2 million in a convertible note and you build in a company and you haven't raised another round, you may not have the benefit of being able to pay back $2 million in 24 months. And so you had this renegotiation that happens often at maturity if you haven't raised another round. And so a SAFE was introduced where you still have a cap and you still have a discount, but you don't have a maturity date or an interest rate. And that is the most favorable security or instrument that's available to founders in raising these early stage rounds of funding before you're ready to issue preferred stock and price your round. In terms of investors doing series later stage financings, with the tremendous amount of VC capital that is available as you're growing, you see more and more companies growing into unicorn status off of venture funding. So doing series A, then B, then C, then D, and sometimes E. You know, you're going into these later, bigger and bigger rounds, raising hundreds of millions of dollars sometimes from VCs, versus going public or holding off going public or holding off selling the company. And so the availability of all of this later stage capital that's available now, and depending on market conditions for going out for an IPO or M&A market conditions, you have this option to do these later stage rounds. So you are seeing a lot of companies go into being multi-billion-dollar companies and still be private.
Great. Thanks, Anthony. Luis, I believe you had a question as well. Feel free to unmute yourself.
Thank you. Thank you. Good morning, everyone. Anthony, I have a question for you. COVID and obviously this war has disrupted, I understand, funding for, especially in the angel space. So where do you see now for the balance of 2022 going into 2023? What is the biggest fear for investors? Because as we are now ready to go back and ask for, do another round of pitching our company, we're in the trade show industry. That space has been really disrupted because of COVID, and now it's being disrupted because of other things. So what's your view on the how comfortable are investors looking at startups at this stage?
We're still on our side seeing a tremendous amount of activity. I mean, we've had a number of startups doing early stage seed rounds from angels or institutional angels, and we're seeing multiple closings each week in the rounds. And so raising capital is always a function of finding kind of investors who are attuned to your business and the area that your business is in, finding investors who are also focused on the stage that you're in. So it does become important to try to get people who are aligned and you're in their sweet spot. But we definitely we're still seeing activity every day. There is a lot of capital that's out there now. There's been a lot of capital raised by funds. On the earlier side of the market, you may see kind of more of an impact of a little bit of an increase in cautiousness from just straight angels. But institutional angels and VC funds, we're still seeing a lot of activity. And I think that is, and it kind of forces, as a founder, building and going out to raise additional capital now, you really kind of need to try to hone in and find people who are still investing in your space.
Great. Thanks, Anthony. Thanks, Luis. David, you raised your virtual hand. Feel free to ask your question.
Yeah, thank you. Thank you for allowing me to. So I'm an investor in one company where we're going out and raising a second round of financing. And it's kind of a two-part question. First is we've been told the CEO who's kind of driving this business has not a great amount of vested interest in the business. So we realize that one of the things that we need to do is get him more vested, because that's what investors are asking for. They want to see somebody running the business who's got a vested interest in it. So we've kind of settled, I believe, on restricted stock units. And my question is really, A, does that sound, with the limited information I gave you, a good strategy and number two is, how do you value that? How do you value the restricted stocks vis-a-vis the existing shareholders and themselves?
Right. So when you are issuing stock, common stock to founders, the first part of your question as an investor, right, it's all about execution. And when you look at the different risks in a company, at the end of the day, in early stage companies, the business may pivot, it may change direction, it may go through a lot of different iterations, but the core ingredient is the team and having founders who are committed and incented to push through and stay and build the business. So I think having sufficient stake for the founder is really critical. The second thing is, you want that founder stake to, typically you're looking for that founder stake to be a vesting stake, right? So that it's not owned all upfront, because if it's owned all upfront, the founder can leave and leave with that ownership. You want that founder shares to be vesting over time. And sometimes when investors come in, if a founder owns their full stake, they may force the founder as part of the investment to take a portion of that founder stake and to turn it into a vesting stake. So it vests over 2 years or 3 years or 4 years. And then there's acceleration on the sale of the company or and liquidity or exit event. In terms of the valuation of those shares, the challenge with restricted stock is that you're not paying for that stock, right? It's being granted to the founder as part of services that will be put into building and growing the business over the next X number of years. So it creates a taxable event if that stock has value. And so there's something called the 409A valuation, where when you're issuing stock options or you're issuing restricted stock, you want to look at the fair market value of that restricted common stock at that moment in time. And sometimes if you've done a round where you had a convertible note or a safe with a cap, that cap may be $10 million or $20 million or $8 million, but the 409A valuation is looking at it's looking at a little bit differently. It's really looking at the value of that common stock today. And often it's significantly lower than what the cap would be on the next round. And part of your strategy as to whether you're issuing stock options or restricted stock to the founder is going to be where that 409A valuation comes in. If it comes in based on 5 cents a share or 2 cents a share, which translates to 2 million in value instead of 20 million in value, it's going to lead to one decision. If it comes in very high, creating an immediate taxable event for the founder, you don't want to solve one problem, which is having the founder be committed to the business, but create another new problem where you've now created a big taxable event for them. So those would be the steps I would look at. Number one, yes, you want the founder to be committed. Number two, you have vesting stake. 3, you do a 409A valuation, and that tells you whether or not you're going to be focused on stock options or options or actual equity.
Great, thank you very much. Appreciate it.
Thanks, David. Anybody else have a question they would like to unmute themselves and ask? Well, I have a question, Anthony, that I get a lot when I'm speaking to potential clients. And it has to do with corporate structure when you're fundraising, the age-old LLC versus C Corp question. Maybe give a brief synopsis or overview of what it's like to raise money as an LLC versus a C Corp and what you like to recommend to entrepreneurs.
Sure. So we often will have companies that started out initially as LLCs, and they're getting ready to go out and raise capital. And like Lisa just indicated, one of their first questions to us is, is this when we should be converting to just say a Delaware C Corp? And part of that question is there are a number of drivers as to whether or not this is the right time to do it. One,
let's see, Anthony, be frozen for anybody else or just me?
He's frozen.
Yep, frozen.
Frozen.
Confirming.
Well, didn't anticipate that. But fortunately, we have our phenomenal associate, Brittany Gordon, on the line. Brittany, if you're available to jump in and have some insight into the LLC versus C Corp when you're fundraising, chime in. And if not, I will continue on. Hopefully Anthony will rejoin in a minute. So in my experience, it's not that you can't raise money as an LLC, but it's a little bit more complicated. When I was running my company, we did raise money as an LLC, but it required, oh, you're back. Terrific.
we got a hiccup on our
Oh, we
network.
did. Go ahead, carry on.
Yeah. So what we were talking about was for institutional investors, they're not looking for investing in a pass-through entity because of the impact it has when profits and losses pass through to them. So that's the first thing. Are you getting ready to raise a round of capital with institutional investors? And in which case you may want to this could be the time that you need to convert ahead of that, or at least in your term sheet indicate to investors that upon immediately before closing, you will convert. Another reason why people convert as they're ready to raise capital to a C corporation is from a stock options perspective. If you're going to use that money and you're going to be adding a number of employees and consultants and advisors who you want to issue stock options to, but particularly around employees, you want to be able to give them the tax benefit of an incentive stock option. And those are only available to corporations. You can try to mimic stock options in an LLC through unit appreciation rights, but you don't have the same benefits that you have, as well as when you're bringing on employees in a competitive employment market. People are very used to getting stock options and they understand stock options, and trying to kind of explain to them what a unit appreciation right is and how a unit appreciation right is going to work is something that also favors switching to a C Corp. Another reason why people will look to switch to a C Corp is that there are tax benefits if you hold shares and you are a qualified small business stock company under Section 1202 and your shares are held for at least 5 years. There are significant tax benefits upon the exit of that company that drives people to want to be a C Corp to start the clock on that. In terms of the LLC, people will want to convert to a C Corp. Also, on the other side, with the reduction in the corporate tax rate down from 35%, where it used to be, to around 21%, even the double taxation issue isn't as big an issue and challenge as it used to be for companies where you pay a corporate tax and then when you distribute capital out. And then you also have to look at, if you are generating revenue, are you going to be reinvesting for growth, or are you going to be distributing out? And if you're going to be really trying to reinvest profits for growth, again, profits and don't distribute anything, there's issues that are created for the owners of an LLC from a tax perspective. So on one side, you've got a number of benefits if that's the type of company you're building, to move at that point in time to a C Corp. If you're going to not be doing those things and you have a lot of losses that you want to pass through to owners, or if you're building a business that doesn't have that, and you have doesn't have those triggers for moving to a C Corp, and you want just you want to distribute profits out to the founder for being an LLC. But there are a lot of drivers for building a high growth company to want to start off as or to convert to a C Corp. And the process of converting to a C Corp is very manageable, to move, for instance, into Delaware from a different state, an LLC in Maryland or Virginia or DC or California. And there is a set way to move into being a Delaware C Corp. You just have to build in a little bit of time, a few weeks, to get that all done and worked through properly, particularly if you have a more complex cap table.
Terrific. Robert, I see you've raised your virtual hand. Please chime in and ask a question.
Yeah, real quick, actually, on that same topic, we're a C Corp in Delaware as of 2019, and recently, for registering as a business in DC, they required a corporate registration here as well as a foreign entity. Mm-hmm. And then I started looking through our documents. It seems like now we have some duplicity where we have two corporations registered, right? We have the original Delaware corporation where we have a registered agent, and now we have this DC corporation. So I just wanted to run that by you and see. Obviously, you've probably seen this happen a lot, but I just wanted to make sure that, this is pretty standard.
Yeah. So you only have where you incorporate is which in your case was Delaware. That's where you're incorporation. And
I'm sorry, can you repeat that? It cut out.
Yeah, that when you were set up as a Delaware C Corp. And so that is really, when somebody says, where are you incorporated? That's where you're incorporated. You're a Delaware C Corp. Where you do business in different states, like you're talking about DC, and maybe you're doing some business in Maryland or in New York. Different states have different requirements for when you've crossed the threshold that requires you to qualify as a foreign corporation to do business in that state. So you don't have two different corporations. You have one corporation. It's a Delaware C Corp that is qualified as a foreign corporation to do business in DC. You are paying franchise taxes in two places. So you are paying something to Delaware, and then each state that you qualify as a foreign corporation in, but it's not two separate legal entities. It's just one legal entity. And from an investor's perspective, as you're growing the business, investors really like Delaware corporations because they're very familiar with Delaware law. Most companies they're investing in are Delaware companies, their lawyers, their documents, their familiarity, the predictability of how things will be treated and handled in Delaware, or make Delaware the first choice place for anyone setting up a company. But when you are doing business in different states, you have to do an analysis and see if the amount of business that you're doing has reached kind of that threshold, and then you qualify to do business in DC. So you're set up for a company that's looking to build and grow and raise capital, a structure of being set up in Delaware, but then qualifying to do business in DC as a foreign corporation is the way you would typically see it.
All right, thanks. Yeah, that's how I understood it.
Great. Well, I think we have time for maybe one more quick question. If anybody has one, chime in.
Yeah, I'd like to just ask, when do you think the most opportune time is to take on debt, as a startup company? I would think that you would want to be generating some revenue, but equity can be expensive and debt's always a good option to look at.
Yeah, so great question. What's really interesting on the debt side is traditional debt is challenging for early stage companies that don't have revenue or kind of from a bank's perspective, bankable for debt related funding. So traditional bank debt, they're doing a lot of analysis of revenue and profitability if you're not being required to give a personal guarantee. It's a little different in terms of personally guaranteeing that debt. It is very interesting that there is a growing trend of venture debt or alternative funding that is non-dilutive for earlier stage companies that's part of the capital stack along with raising equity financing, which is dilutive. And so you are seeing a number of funds that are forming specifically where they're getting it's debt with interest and warrants. So there is an equity component to it, but they're willing to take risk as long as they can get comfortable with the assets or with the inventory or with the receivables, different components of the revenue. But there is definitely a growing trend that we're seeing of alternative funding that's debt oriented with an equity component that's less dilutive or that goes into the capital stack side by side with the equity funding. And so that's definitely something to do, if you're raising money, to look out for.
And you would need a valuation on that, and it could be tax advantageous to do that. Correct.
There are, if you're a company that can bring in some equity and some alternative debt funding, the big benefit to that is, like you said, equity is necessary and critical, but expensive over the long term because of the dilutive impact or the portion of the company that you're giving away for that. Now, if you're bringing in capital that comes with a lot of strategic guidance and value that's helping you not only have money and solving a capital need, but also helping reduce your risk or de-risk the company and increase the likelihood of growing to the next level. It's worth that dilution, and it's worth that. But definitely for companies that have assets or inventory or are generating revenue, looking to see if there are any other types of funding that would go into the capital stack, not necessarily replacing equity, but reducing the amount of equity you need to bring in because you're bringing in some of this alternative funding is out there now and something that entrepreneurs and founders can look for.
Thank you.
Well, thank you all so much. That ended appropriately and perfectly right at 11:30. Thank you all for joining us. Anthony, thank you for your insightful responses. As mentioned in the chat, these Founders Q&A will occur the last Friday of every month at 11 a.m. ET. I've included links to our events page on our website. We've got lots of fun things coming up, including a crowdfunding webinar on April 6th, which is another great alternative funding route. Follow us on LinkedIn to stay in tune, and we hope you have a great Friday and a fantastic weekend. Thank you all so much.
Thank you.
Thank you.